The S&P 500's price-to-earnings ratio is currently hovering near 40. The last time market valuations reached this height was during the peak of the dot-com bubble in the year 2000. This animated chart maps our recent inflation data. After months of steadily trending downward, you can see the line suddenly hook violently back up, hitting a 3-year high of 4.2%. When you dig into the data behind that spike, the cause is very specific. Conflict in the Middle East has caused energy costs to nearly double in just 6 months, forcing businesses to pass those elevated prices directly onto consumers. We have the most expensive stock market in a quarter century, colliding directly with an aggressive, unexpected surge in the cost of living. In the middle of this collision, the Federal Reserve's entire economic outlook flipped. Kevin Warsh has officially replaced Jerome Powell as Fed chair, and instead of the widely anticipated rate cuts, the Fed is now preparing to increase interest rates in 2026. Historically, the Fed communicated these moves through a scatterplot like this one, known as the dot plot. Members place dots to signal future interest rates, giving investors a clear trend line. Kevin Warsh wants to eliminate that system entirely. Believing the Fed should signal less and do more, they would issue zero future guidance. Operating without a map forces massive institutional investors to guess the central bank's next move. When trillions of dollars are forced to guess during an inflation spike, caution vanishes and aggressive selling begins. We are seeing this uncertainty hit the tech sector in real time. SpaceX has just launched the largest IPO in history, entering a market totally consumed by artificial intelligence hype, with a massive $2 trillion valuation. This bar chart compares tech IPO returns since 2010. The high average return is skewed heavily by a few rare lottery ticket winners like Shopify. When you strip out those anomalies, the median tech IPO actually loses money by the end of its first year of trading. Companies that hit massive 30 times returns do so because they start small and grow into giants. At $2 trillion, SpaceX is already a giant. There is virtually no mathematical runway left to produce those exponential multipliers. Early private investors know this. They are using the overwhelming public hype surrounding AI and space exploration as exit liquidity, offloading their shares at the peak before the broader tech bubble bursts. In the real estate market today, elevated mortgage rates have aggressively thinned out the entire pool of qualified buyers. The sheer cost of borrowing has simply priced an enormous chunk of the population out of the housing market entirely. Typically, a massive drop in buyers forces sellers to lower their asking prices. Instead, current homeowners, many locked into rock-bottom interest rates from a few years ago, are stubbornly pulling their listings off the market at a record pace. Take a look at this graphic tracking housing supply and demand. As the buyer pool shrinks, taking weight off one side, the inventory of available homes shrinks perfectly in tandem on the other. Because supply and demand are falling together, home prices stay artificially high. The entire housing sector is essentially frozen in a stubborn standoff where neither side is willing to blink. The crypto market right now is experiencing an even harsher reality check. Bitcoin has plummeted 40% from its all-time high of $124,000, recently hitting its lowest point in over a year. A significant portion of this fragility traces back to a single corporate entity, MicroStrategy, and its executive chairman, Michael Saylor, who holds slightly more than 4% of the global Bitcoin supply. This flowchart maps out their highly leveraged strategy. MicroStrategy issues new shares of company stock to raise cash, buys more Bitcoin, and uses the rising asset value to pay out a hefty 12% dividend yield to their shareholders. But if Bitcoin's price drops, the mechanism breaks. They have to sell their Bitcoin to cover their overhead, which drives the market price down further, forcing them to sell even more to stay afloat. In June, MicroStrategy sold just 32 Bitcoin out of a massive reserve. The moment that tiny fraction was disclosed, the entire market panicked. It proves just how dangerously dependent the entire crypto ecosystem is on constant upward momentum to avoid total collapse. This brings us right back to Kevin Warsh at the Federal Reserve. He has inherited an economy with a war-driven oil shock, the severely inflated tech market, and deeply fragile housing and crypto sectors. This diagram outlines his impossible choice. Option A raises rates to kill the inflation spike, instantly shattering the overvalued tech, housing, and crypto markets. Option B does nothing, hoping a peace deal lowers oil prices. If that fails, inflation spirals completely out of control. The underlying health of your portfolio right now is entirely at the mercy of unpredictable global events in the Middle East, rather than relying on sound, predictable domestic policy. In a single week, we witnessed the largest IPO in history, the hottest inflation in 3 years, and Bitcoin cutting in half. Predicting the outcome of these overlapping crises is mathematically impossible. Trying to dart in and out of the market right now based on hype, fear of missing out, or a guess about what the Fed might do next is a guaranteed way to lose your capital. When the central bank blindfolds you, the only proven defense is consistent, emotionless, long-term investing. The investors who quietly buy into index funds right now and refuse to panic are the ones who will ultimately walk away with the wealth.